Hi, welcome to Market in a Minute. Hope everybody had a good holiday on Monday. They asked me what I did on Monday. Well, it gave me more time to work. USA, it's been fun watching the Olympics too. The markets. Technology needs 2027 visibility. So if we're starting to look at 2027, some of the stocks look really compelling, but we're not there. We've got some more time to get through. There's a little bit of a cloud over tech right now. And then the rotation. Love the rotation. It's been nice and strong. But we need lower interest rates. So to get lower interest rates, we need inflation to come down. We think inflation is coming down. This is uber bullish for the markets if inflation continues to drop. And if inflation continues to drop, then we get the 10-year Treasury coming down. So inflation coming down sparks a 10-year Treasury to go lower in yield and in continuation with this rotation. And then it's also going to help technology stocks as well. So here are disclosures. Please stop the video and read for yourself. The market update. Just to reiterate a few points. So we believe that we're going to see volatility this year. Something like last year, could see a 20% drop from high to low. Expectations are high. We're somewhere around 15% earnings growth for this year for the S&P 500. A lot of that coming from tech, with about 30% growth out of tech. So there's high expectations. So companies can't disappoint. If you notice, the companies that beat go up a lot less than companies going down when they disappoint. The S&P up 3 years in a row, double digits, going for 4. That's tough historically. It's tough to get 4. It's happened a few times, but it's tough. Technology, just the weighting in the S&P 500, how they break it out, is 33.4% in tech. Now, if you add back all the tech-related companies, Amazon, Google, Meta, Tesla, into that, you get 47.9. So it's been about 48% in tech and tech-related. Hasn't changed a whole lot, even with tech being soft. In the short term, okay, we've seen a lot of movement out of the value, small cap, mid cap. International has been strong. We think it's creating volatility now in those particular names until we get lower interest rates. So here's the Russell 2000. Russell 2000 over the past 6 months is up about 16%. And you look at tech is up about 5 over the last 6 months. So you can see that rotation that has occurred. And then you break out the names a little bit. Look at AMD, for instance, versus Lowe's, okay? Two kind of comparably quality companies. They're comparable. AMD is not the biggest semiconductor company. Lowe's is not the biggest retailer. Both are quality companies that are growing, reasonably well. AMD is down 5%, roughly year to date, and Lowe's is up 16. So you can see that rotation that's occurred in the market. Well, Lowe's is now 22 times earnings on 2026 estimates, and it was 17 times. So it's had a nice move. So NISA's lower interest rates. AMD is 37 times 2026 earnings. Yeah, 37 times 2026 earnings. It's growing nicely, and it needs those earnings growth to come down in value in 2027 to make it reasonably priced. 22 and a half times 2027 earnings. So you can see what I'm talking about. The market needs to shift to 2027 for its focus. Getting lower interest rates will do that. So the market will start to look out further the more confident it has in the overall markets itself. So big difference between the technology and the reacceleration trade in general. That's been happening. We think that probably both are due for a pause unless we get those lower interest rates. So to continue to get rotation, we need a cut in rates or the 10-year Treasury coming down more. The CPI report was really good It's a beautiful report. They're still talking about this report. It was 0.17% month over month, which equates to about 2% annualized inflation. We have more inflation numbers this week. We'll see how that turns out. But for the Federal Reserve to be at 375 when the run rate is approximately 2% inflation, they're too tight. So we talked about this last week. Those of you who didn't see the video from last week, a red market minute, go back and get that. We talk about Stanley Druckenmiller's view of 2026, a liquidity trap is here. So go to his YouTube site and look at that video. It's really worth looking at and then dissect it. So for the liquidity trap to happen, we need inflation to be high. So inflation being stay where it is, 3% roughly is what the market's thinking. If it stays in that range, the Federal Reserve is handcuffed. If it comes down to 2%, well, that liquidity trap is dead. Now the technicals. We've been moving sideways on the S&P 500 for a while now, for 3 or 4 months, moving sideways. We come down to the 50, or we touch the 100-day, and it bounces off of it. We're right around that 100-day moving average. We bottomed out here a couple times in a row. We're at a critical point. If we break through that 100-day, as the market's gone sideways, the moving averages have caught up to it. So we break through the 100-day, that will be a pretty negative signal. Might come down to the 200-day, maybe have to test that as well. So we're at an important point for the technicals of the S&P 500. Now the positive side is the 10-year Treasury is in a buy mode. Broke through the 200-day moving average, the 20-day, the 50-day, the 100-day. It's almost down to where it usually stalls out around 4%. It's at 405. If it can break through there, if it clear that 4% and stay down below that, that's what we're talking about. That's really bullish. So what I would like to see is the 10-year at 375 when the federal funds rate is still 375. That would be in your face, pal, what the market would be saying. That's a possibility, but it's really close to that now. If the 10-year is 405 and Fed funds rate 375, that's too tight. The Fed needs to cut rates. Stocks. Okay, so we've talked about Viking in the past quite a bit. We were in early, like 2022, when obesity was just a twinkle in their eye. Really was nothing going on in the obesity space with them. They had a fatty liver disease drug that looked really promising, and they said, this works for obesity. And so you can see this big move up as this started to get into the markets that they had a drug that would work well for obesity. We sold a lot of our stock, or all of our stock, around 69, and subsequently bought it back in the 30s and 20s, and believe that that we got solid support here. We believe that this drug works well for obesity. The FDA gave them a clear path to start phase 3 on their oral drug, so they'll start that in the 3rd quarter. On their quarterly conference call, so this is where they announced it. It was a love fest with the analysts. So I think with now the street behind this, I think most sell side analysts like this a lot. The buy side hasn't gravitated to it yet. I think the stock has quite a bit of upside. We put a fair value on an acquisition of this as high as $15 billion. So that'd be $125 per share. We think it could go between 10 and $15 billion. That fatty liver disease drug, if it was on the market, it'd be worth $10 billion. Lots of upside in this. We like this one a lot. So on any pullback, we'd be adding to these positions personally. Marvell, this has been one of our picks. We picked it off nicely. It ran up a ton. It's pulled back with the technology. Again, they drift off of Amazon. So Amazon really increased their spending in a huge way. They're over $200 billion, a huge increase. Okay, so on the previous expectations, Marvell is currently trading on at 20 times 2027 earnings. So again, if things play out for tech as we get closer to 2027, 20 times is going to be a very low multiple for this quality of company. And we could buy it here now, or we could kind of wait and buy it later. But this is a value based on probably what's going to end up being a really attractive, kind of stable to growing mode in the AI infrastructure build out over the next several years. Amazon, again, 21 times earnings. It's on 2027, I should say, and it generally trades no lower than 29 times earnings. So the delivery business, they're dominant. What a great business. That Amazon guy comes to my house every single day, it seems like. So 29 times earnings for a real franchise company. That would be the fair value for it. It's currently 21 times at 2027. Again, we need to start looking out to 2027. I think there's a real value in Amazon, and it'll start to be realized as we go through the year. J&J, love this company. It's done great. We've made a lot of money on it. It's expensive relative to its growth rate now. So it's one of the beneficiaries of that rotation trade. So we're looking at maybe exiting this position. Our favorite financial stock, Capital One, a big cap financial stock. So this is pulled back quite a bit based on that 10% cap that Trump wants to put on credit cards. I don't see that happening. That's going to be really tough. So this is our favorite on the large cap financial stocks. Uber is the way to play, in our opinion, autonomous driving. Now we see what Tesla's doing. Google's doing well, and there's a little bit of cooperation between the companies there. Uber owns the ride-sharing business, so who's going to benefit? The ride-sharing companies are going to benefit from autonomous driving. They're going to have it. So they already have the customers. They have the app. They're going to have significant cost reductions. I like Uber a lot. Some other stocks we've talked about on holdings, great tennis shoe. We think they got great momentum. Now this is a nice replacement for Nike. Nike's still very expensive relative to the growth rate they see on holdings is not. So ON. Floor and Decor. Okay, this is a growth cyclical. They could double the size of their store base. Okay, so you're going to see 20% square footage growth out of these guys over time. So 20% square footage growth on top of an improving cyclical environment. Floor and Decor should do really well. Now we've talked about Butterfly Networks a little bit. Stocks pulled back. This is an ultrasound play. So this is a little chip they put on your body, and it could quickly, image your body. So it's fantastic for the emergency room, and it's going to be a lot lower cost for hospitals who use this chip device that they have. Now, IonQ, this is quantum computing. Quantum computing is going to be huge at some point in time. This is a great way of playing it. This is the blue chip, pure play of quantum computing. Stocks pull back a lot. When the market heats up again, this could probably easily double in size. Now, just thinking about this, okay? We're a little bit in uncertain times in the markets. We're in no man's land, right? You don't have a good ground stroke to hit. You're not close enough to the net. We're in no man's land. So we wouldn't be in no man's land or any other period really, but we wouldn't be in this area without the ability to protect the downside. It's critically important. What if Stanley Druckenmiller is right, that there's a liquidity trap this year in the markets? You need that ability to protect yourself. So this is what I do at my firm. We use hedging to take out the downside risk in portfolios. So if the market's going to fall 40% as we trip these moving averages, we can quickly protect ourselves. So if you have any questions, come to my website, Patrick Adams CFA. You can access the contact information there. Ping me off the video. Come to my company, PVG Asset Management, and you can see some of the strategies we have. Some of the strategies have really attractive long-term performance. Not as good as Stanley Druckenmiller's, but still really darn good long-term performance. Take care.